Hello everyone. So welcome to the first recording of 2019 and the first recording of Intermediate Finance 2, also linked to CSC Part 2. So the first chapter that we are going to discuss is about fundamentals and technical analysis. So highlights of this chapter are, so we have seen a part of it in level 1. So we have discussed about the regulatory system, we have discussed about security market in general. So we'll build on it on level 2 and look at the bigger picture. The focus on chapter 3 is fundamental and technical analysis of economy and industry. The focus of chapter 4 is company analysis and use of financial ratios. The objective is utilizing the tools of investment analysis for better security selection decisions. So there are two types of analysis. So this type of analysis is majorly used for analyzing stocks, but it can also be used for analyzing bonds and other investment. So when you analyze stocks, you make buy or sell decisions. Now, how do you make this buy or sell calls? You can either use fundamental analysis or you can use technicals. Fundamental analysis is trying to figure out the story of the company. So look at, means when you do fundamentals, you look at the past, you try to analyze the present, and you try to predict the future, right? Technical analysis looks at the behavior of market. So you try to analyze the behavior of market participants. So you try to figure out the demand and supply of the stock. So you can either use fundamentals or use technicals or combine both, right? Now, fundamental analysis accesses the short, medium, and long-term prospects of different industries and companies. Look for everything and anything to determine how security prices will change. Just a second, I'll zoom out a bit. Yeah. So that the view is better for you guys when you see this recording. Technical analysis focuses on stock market itself. It uses charts and patterns of past stock behavior to predict future price movement. So it focuses on the market itself and tries to analyze its behavior. Now there are different market theories. The first market theory is efficient market hypothesis. Now efficient market hypothesis says price reflect everything. So if there is a good news about stock, the prices will go up, reflecting that. If there is some bad news, prices will go down. If the company has not performed up to its expectation in the past, so stocks will go down, and if it has outperformed its expectation in past, it will go up. And if the company has strong prospects in future, the stock will go up, reflect that. And if company prospects in future are falling, then the stocks would reflect that. So stock prices reflect everything: present, past, and future expectations. The market price of a security fully reflects all information, and therefore it is difficult, if not impossible, to consistently outperform the market. It means that you, by not taking any risk, you cannot beat the markets. So whatever return the market is generating, you will also get that, because everyone has the same information, everyone is analyzing the same information, and prices reflect everything. So you cannot time the market. That is what this theory says. It also assumes that the stock price cannot remain in disequilibrium or be improperly priced for a very long time. So it will tend to move towards equilibrium. Implications: if markets are efficient, then an investor should spend less time analyzing stocks and more time on reducing taxes and transactions. That is, instead of going for an active management approach, active investment approach, whereby you pick stocks, you should go for a passive approach. In passive approach, you just buy and hold, okay, and majorly you deal with exchange traded funds rather than individual stocks. The only way to increase return is to invest in a portfolio of high risk securities. So it's means that the only possibility of you to increase returns, right, for your portfolio is to take more risk. So there is no free return. If you want more return, you have to take more risk. If the market is efficient, one cannot use fundamental analysis to determine if the stock is undervalued or overvalued. Now there are three levels of efficiencies. There is weak form efficiency, in which all past information is reflected in prices, but future information is not reflected. So in such a situation, when you have weak form efficiency, technicals won't work, because technicals relies on past data, but fundamentals and insider information can work and you can get above average returns. Then there is semi-strong form of efficiency, in which all present and future expectations are reflected in stock price. In such a case, technicals doesn't work, fundamentals doesn't work, but you can still beat the markets by having some insider information. And there is strong form efficiency, which is highly theoretical, in which even insider information is quickly reflected in stock prices. So you cannot beat the markets by using technicals, fundamentals, or even by using insider information. So market efficiency has three forms: weak form, semi-strong form, and strong form. Weak form means technical doesn't work because past is reflected in price. Semi-strong form means fundamentals and technicals don't work, but you can still beat the markets by using insider. Then strong form efficiency, in which nothing works, even insider information, and you cannot beat the market. So best way is passive investment approach. Now the critics to this theory say not all investors receive the new information at the same time, nor process it at the same rate, nor interpret it in the same light. So even though information is there, it may not be perceived in the same way. Okay, so there are two schools of thought. There is a school of thought that believes in market efficiency, that markets are efficient and you cannot beat the markets. Then there is another school of thought that believes that markets are inefficient and we can time those markets using those inefficiencies. The next theory is random walk theory. So new information is decimated randomly over time. Price changes are random and they bear no relation to past price changes. So it means at any given point of time, stocks do not move in trends. They means past price doesn't indicate where the stock will move. The past trend not indicate where the stock will move. For example, if Apple is continuously moving down, so it has a downward trend, but at any given point of time the possibility of Apple moving up and moving down is the same. So even if it is moving down consistently, the future doesn't reflect it. Future is random. Possibility of moving up, moving down, means remaining at the same level, it has 1/3 possibility of doing each of these. So movements are completely random. Stocks do not move in trends. New information is decimated randomly over time. Hence, the price changes are random and they bear no relation to past price changes. Implication is technical analysis is not useful. Technical analysis, one of the assumptions in technicals is price moves in trend. That is, past price behavior has a bearing on future price behavior. So if prices don't move in trend, they are random, then there is no utility of technicals. However, if market is less than perfect, the absorption of new information may be gradual. thus producing gradual shift in demand and supply patterns which can be recognized using technicals. The last theory is rational expectation theory. So it is based on the assumption that people are rational and make intelligent economic decisions after weighing all possible information. Given two securities of equal risk, a rational investor will always choose the one with highest return. And given two securities with the same rate of return, investors always choose the one with lowest amount of risk. So this means all investors think similarly. So all investors are intellectually similar. They get the same information and they analyze the same information in the same way. Okay, so everyone is rational. There is no irrational behavior in the market. Everyone is intelligent, everyone is smart, and he or she makes rational decisions. Implications: if investors act in a rational manner, then current prices are correctly means current stock prices correctly represent the information. This being the case, then small investor can do just as well as the large investors, because everyone is processing the information in the same way and getting the same information. So there is no distinction between a small investor and a big investor. Past mistakes can be avoided using available information to anticipate change. Counter arguments: investors are not always totally rational in their choices or their expectation. Psychological factors such as fear and greed may drive the market or individual stock prices. Now, which theory is correct? So it is believed that market is not 100% efficient. Given the new information is not always received and processed at the same time, the psychological motives may influence some or all stock prices. So technical analysis has its place. While past performance is not indicative of future performance because of random events, over time, stronger companies, that is companies that have performed well in past and they're performing good right now, they tend to perform well in future also. So stronger companies usually perform better than weaker companies. Hence there is a need of fundamental analysis of industries and companies. Interest rate, economic variables influence individual and industry stock prices. So fundamental macro analysis and understanding the underlying factors is required. So book also says that the best approach is to combine both. Fundamentals will tell you what asset class to buy, so what stock to buy or what stock to sell, right? Technical analysis can be used to complement fundamentals to time the market. So let's say fundamental analysis is saying that Apple, Apple is a good stock to buy, right? But technical analysis, you can find out whether it is a good time to buy Apple, whether the prices are good, whether the trends have reversed. Okay, so you can complement fundamentals by using technicals. So fundamental macro analysis, okay, fundamental analysis is done in 3 levels. So economic, industry and company. Now there are 2 ways to do it: top down and bottom up. In top down approach, we start with the economy, then we analyze the industry, and then we narrow down on the company. So we look at the economy first, the global economy, the country's economy that you are investing in, the economic factors, etc. Then you look at the industry, how it supports, how the economy is impacting the industry and how industry is performing, the industry you want to invest in. And finally you look down at the company within that industry. This is top-down approach because it starts at the top and it narrows down on the company. Bottom-up approach is you start with the company that you are interested in, then look at how industry is favoring or not favoring the company, how are the industry growth prospects, and then you look at the economy. This is called as the bottom-up because it starts at the company and ends at the macroeconomic analysis. Now we'll start with economic analysis first, then we'll move down to industry. Company analysis will not cover in this chapter. We have chapter 14 to do that. So fiscal policy impact. So economic analysis, the first part is fiscal policy. So fiscal policy has three parts: government spending, taxation, and debt, government debt. So government spending, government taxation, and government debt. Now first, government spending. So government generally spends on services, infrastructure, and transfer payments. The impact of government spending in short run is that it pops up the economy, but in long run it depends where the government is spending. Generally infrastructure spending is taken as positive, means other types of spending like transfer spending is generally not considered to be positive economically. Okay, but short term impact is if government spending increases, so does, so means it is taken as a positive sign by stock markets. The next is government taxation. Now if government increases taxes, then individuals in that country will have lesser amount of money to invest and to spend. So it is generally considered as negative for the economy and the market, because then if individuals are not spending, companies don't have much, means don't have increase in sales and increase in profits. Okay, other way around, if the country decides to reduce taxes, corporate as well as individual, the aggregate spending in the economy pops up, which has an impact on stock prices as well and taken positively. So decrease in taxes is generally considered positive. Last is government debt. Increase in government debt ties up the future income. So future flexibility of the government and its citizen decreases if the debt increases. So increase in government debt is not considered positive by the markets. Decrease in government debt is generally considered a sign of a positive and a strong country. Okay, so fiscal policy has taxation and impact of taxation, but there are time lags. So any fiscal policy has to pass through the parliament. So it has to pass through the lower house and upper house in Canada, and it takes a long time to do it. So any rules that the government comes up, it depends on the current political structure and all those things. So there is a time lag between when the government decides to do it and when it actually starts happening and impact can be seen. Okay, the next is monetary policy. So monetary policy in the book, means we discussed monetary policy in greater details in level 1 with SPRAs and SRAs and etc. But in level 2 we are just going to briefly discuss it. So monetary policy is done by Bank of Canada. The objective of monetary policy is to control inflation. There are three objectives basically: to control the growth rate of the economy, to enhance or decrease the growth rate of the economy, then to control inflation, and finally to maintain the purchasing power of Canadian dollars. So Bank of Canada has three objectives: to boost the economy, to have a sustainable growth rate in Canadian economy, to control the inflation, and finally, means the third part of it, to control purchasing power of Canadian dollars versus the major currencies. Now how does it do it? So book says that it changes the short-term interest rate. So it increases or decreases the short-term interest rates. If it increases the short-term interest rates, then the economy shrinks, then it is it accelerates the economy and it decreases the inflation. If it reduces the short-term interest rates, then it boosts up the economy and it increases the inflation. Now the book also says that when Bank of Canada increases the interest rate, short-term yield increases, right, and the long-term yield falls. That is, the yield curve tilts. So we have discussed yield curve in level 1. So whenever short-term interest rates are increased, the yield curve tilts. Now this tilting of yield curve is considered by the market as a sign that market participants are agreeing with Bank of Canada. And due to this, equity becomes reasonable as an investment compared to long-term bonds, because long-term bonds are falling in yield. Okay, so Bank of Canada monetary policy consists of increasing or decreasing short-term interest rates. Increase in short-term interest rates generally causes the yield curve to tilt, means the short-term yield increases and the long-term yield on bonds fall. This is considered by market participants as approval for Bank of Canada policies, and it leads to equity being a reasonable investment as compared to bonds. So monetary policy consists of changing the short-term interest rate. It impacts the bond market. So short-term yield increases, the long-term yield falls. It creates tilting of yield curve. Then there is flow of funds also. It depends on the exchange rate. If Canadian dollar is getting stronger, funds will flow into Canada. The investment funds will flow into Canada. If it is getting weaker, funds may move out. Increase in inflation is generally considered bad because it increases cost for the companies and decreases their profit margins. Decrease in inflation is generally considered to be good, but you have to remember that it's not planned. It is like sudden rises or sudden falls in inflation. Sudden rises are not considered positive, sudden falls are considered positive. So next is industry analysis. Industry analysis composes of two parts. One is classification of industries, and second part of it is Porter's 5 forces model. So the first part, classification of industries, you can classify a company into one industry based on similar product and services. So for example, Apple manufactures phones, so it will be considered in phone industry, or it will be considered in tech industry, right? The drawback of classifying a company like this, classifying companies into industries like this, is that one company can be into different product and services. For example, Sony is also into banking. So just looking at Sony as an electronic or a tech company will create into delusions, right? So a better way of classifying is according to the stage in which the products are. So according to stage, if you classify, you have emerging growth, growth industry, mature industry, and declining. So let's see. So in emerging growth, these are new industries. So there is some new technology, there is R&D happening. For example, self-driving car. So commercialization has just started, right? But there is long way to go for a fully autonomous car. So companies that are researching in new tech generally have negative cash flows. They're privately owned or controlled, and they have high risk of business failure. So though the industry is considered to be having good prospects because it is a game-changing industry, but still who will succeed in that industry is relatively unknown. So that it has high risk of investments. Growth industries, there is good commercialization of products. There is high growth in sales and earnings for the companies. Competition increases because the growths are good. The growth is good. Most financing is from retained earnings. Mature industries are characterized by slower growth and intense competition. Profit margin generally declines when so they are like milking cows. So you have good cash flows and good profits. So profit margin is generally declining, but the earnings remain positive, and revenues are sustained by customer loyalty. Declining industries, so competition is there from new product or technology. growth is minimal, and cash flows are initially good, as little is spent on expanding plant and equipment, but they are expected to decline over time. Next part of it is Porter's five forces model. So there are five factors we analyze when we analyze industry competitiveness by using Porter's five forces. So bargaining power of suppliers. So if suppliers to your industry have significant bargaining power, they will take away all the profits that are there in the value chain. They will take majority of profits. So as an industry, we want lower bargaining power of suppliers. Now bargaining power of supplier depends on size of the supplier, number of suppliers, how unique the product is, and can the company move back and start manufacturing itself. Then there is bargaining power of consumers. So bargaining power of consumers, if consumers have significant bargaining power, they'll pay less. So as an industry, we want consumers to have lesser bargaining powers. Bargaining power of consumers, customers or consumers, again depends on size of consumers, number of consumers, then uniqueness of product, also whether the company can forward integrate, that it can be its own customer or consumer. Substitutes are things that can replace the uses of the product. So if there are large number of substitutes, it is not very good for the industry. If there are lesser substitutes, that is good for the industry. Competition, how competitive the industry is, and the competition or the competition is brand based, or means there is some unique features, or it is completely price based. Generally we prefer lesser competition as well as brand based competition or customer loyalty rather than having price based competition. And finally, the threat of new entrants or barriers to entry. If barriers to entry are high in form of patents, copyrights, and non-trade barriers, etc., then it is good for the industry. If you don't have barriers and new peoples are constantly entering, then it is not very good for industry. You can also classify industry by economic cycle. So there are cyclical industries that are extremely dependent on economy. So these industries perform well when the economy is performing well, and these industries generally suffer in sales and profit when the economy goes into recession. Examples of this is infrastructure or means house building and all. So when economy is performing well, infrastructure industry generally is doing well, but when economy goes into recession, that industry struggles. Defensive, so defensive companies are relatively stable across business cycles. So they have stable earnings and profits even in expansion and recession. So they are not impacted much by the business cycles. Example is pharma. So means consumption of medicines is not related to economy. So it doesn't go up and down with the economic cycles. Then there are speculative industries. These are new industries and high risk. They do not have any bearing to economy. Now, next is technical analysis. So technical analysis once again studies the market behavior. It studies the market behavior to analyze past patterns and predict demand and supply. So three parts. Technical analysis studies the market behavior. It tries to analyze the past to see patterns and tries to predict demand and supply. Assumptions of technical analysis: prices reflect everything, prices move in trends, and future repeats itself. So by looking at past, finding the patterns or mistakes that the investors have done, the things that investors have done, we can reasonably predict future. Assumption of technical analysis: market value is determined solely by interaction of demand and supply. Supply and demand are governed by numerous factors, both rational and irrational. Disregarding minor fluctuations in the market, stock prices tend to move in trends which persist or for an appreciable length of time. Technical analysis uses past to predict the future. So future repeats the past, looks for recurring patterns. So price moves in trends, and it is based on the premise that markets it's its own best forecaster, and it looks for stock market index on an average and volumes or share traded. So technical analysis is done by looking at charts. So it has chart analysis, which consists of support and resistance, then reversal patterns and continuation patterns. So reversal patterns are head and shoulders and inverse head and shoulders. Continuation pattern is a symmetric triangle. Quantitative analysis means we also tend to look at moving averages in technical analysis, and sentimental indicators are surveys. They are used by contrarians in the market, and there is cycle analysis. So let's see it one by one. So first is price patterns. So analysts use price patterns to indicate reversals or continuation of trend. Price patterns are visible on chart. So chart in technical analysis is a graph of x-axis having time and y-axis having price. So you see price behavior over time to predict trends. So there are two things, support and resistance. So support is a price point at which the buying activity in the stock increases. Since the buying activity is increased, demand increases. As the demand increases, the price increases. So support is a point at which when the stock reaches that point, demand increases and the stock price starts to rise. Now in technicals, we look at past to find support. So we generally look for previous lows to find support. Okay. For example, in this chart, this previous low is acting as a support in future. Same way, this previous low and this previous low of stock is acting like a support. Same way, resistance is a price point at which people start selling. They sell because prices have become attractive to sell. Since they are selling, the supply increases. Supply increases, price falls. We identify resistance looking at the past for previous highs. So previous high that the stock has achieved acts as a resistance. So approximately this is the previous high. So it is acting like an resistance. Now there are two patterns in charts: reversal patterns that indicate reversal of trend, and continuation pattern. Continuation pattern indicates that the trend is continuing. Now head and shoulder is a reversal pattern. So this is an inverse head and shoulder. For example, it is a downward trend. The stock price rises. It forms one shoulder. So this is shoulder 1. It again goes up and down. So it forms an head. And it again goes up and down. So it forms a shoulder 2. Now if you draw this neckline, if you join these 2 points, you create a neckline. If stock breaks this neckline with volume, it is generally considered that the trend is reversing. So if it was a downward trend, now an upward trend is starting. Okay, so head and shoulder is a reversal pattern. So if it is a downward trend and head and shoulder appears, then it is considered that an upward trend is starting. If it is an upward trend and a head and shoulder appears, it is considered that a downward trend is starting. When do we confirm that the trend is starting? When the stock breaches the neckline with volume. Okay, so this is an head and shoulder in real life. So stock was falling, it created shoulder 1, it created head, then it created an head shoulder 2. and if it breaks this neckline, then the uptrend starts. So if you, this is the point where volume is significant and the neckline has been broken, so an uptrend starts. Next is continuation pattern. Now symmetric triangle is a continuation pattern. It means that the stock was, let's say, moving in an uptrend, it consolidated in a triangle and it broke the triangle and it went up. Now when a triangle is formed like this, it is generally considered that the trend is continuing. The trend still has steam into it, so it is going to run further. Difference between reversal and continuation: head and shoulder reversal, so it indicates that the trend is ending and the opposite trend is starting. Continuation means the same trend, whether up or down, is continuing. Next is moving average. Moving average is constructed by taking average of generally closing prices at any given point of time. For example, if you're considering a 2-day moving average, so today's moving average will be current closing price plus previous closing price. Yesterday's moving average is moving price on that day and one previous, and so on and so forth. So you continue in past. By doing this, you get a line. So this is a moving average line of stock in previous period. Now we generally look for crossovers in moving average line. So if a stock is crossing a moving average line and going down, for example, this is a stock line, this is a stock price line, and this is a moving average line. So if stock crosses the moving average line and goes down, it is a sell signal. If stock crosses the moving average line and goes up, it's a buy signal. For example, this blue line is the moving average line and this is the stock line. So if stock crosses this blue line and goes up, it's a buy signal. If stock crosses this blue line and goes down, it's a sell signal. There are other indicators like sentiment indicator. So sentiment indicator is generally used by contrarians in the market. It's simple. So you take a survey. If market participants are bullish, then you are bearish. So if everyone is, you take a survey on Apple, and if everyone says that you should buy Apple, then you will use it in a contradictory way and you will sell Apple. So you will move opposite to market. So based on the market sentiment, whether the market is saying buy or sell, you make opposite decisions, and it focuses on investor expectations. Then there is cycle analysis. Cycle analysis means that stock prices move in cycles. So whenever we are at the top end of the cycle, we sell, and whenever we are at the bottom end of the cycle, we buy. Because if it is bottomed out, the stock will move up, and if it is topped out, the stock will move down. It assumes that stock moves in cycles. So conclusion: at any point of time, a stock is worth what investors are willing to pay. To some, the prevailing market price may be too high. To others, it may appear as a bargain. While valuation models play a significant role in investment process, there is absolutely no assurance that the outcome may be even remotely similar to forecasted behavior. So in stock investments, there is always risk involved. So thank you for your time. So I'll meet you in the next recording.